Hey everyone, let's dive right into this. Welcome to our latest explainer. Today we're unpacking a truly fascinating period in the financial world, the Q3 2026 strategic synthesis. The core theme we're going to explore today, it's the stark, sometimes totally jarring contrast between market illusions and underlying economic realities. Right now, if you just glance at the surface, things look a certain way. But as we dig into the actual data together, you're going to see this massive undercurrent of volatility, geopolitical friction, and some huge structural shifts happening just beneath that calm surface. Here's our roadmap for how we're going to unpack all of this. We'll start by decoding the index illusion, then examine macro and geopolitical frictions before navigating the AI crucible. From there, we'll expose the great media disconnect, analyze the Q2 earnings catalyst, and finally, we'll wrap the whole thing up with a strategic market playbook. Let's get into it. Starting off with Section 1, the index illusion, focusing on the missing meta factor. So right off the bat, we're seeing a severe index divergence. Take a look at this. The Dow Jones, our classic blue chip index, took a 0.5% drop, which actually snapped a really solid 4-week winning streak. But meanwhile, the Nasdaq, up 1.7%. Why the massive split? Well, it's because the Dow completely missed out on a monster 15% weekly rally from Meta. If Meta had actually been included in the blue chip index, it hypothetically would have added over 500 points to the Dow. I mean, on paper, it looks like a colossal missed opportunity, right? Well, hold on a second, because here is the literal $1.4 trillion asterisk. Meta is actually facing a massive consolidated multi-state trial this August. We're talking California, Colorado, New Jersey, and Kentucky, and plaintiffs are seeking $1.4 trillion in damages. To put that into perspective, that is roughly the company's entire market cap. So what initially looks like a huge missed opportunity on the surface, it means the Dow's exclusion of Meta might actually be a brilliant, completely fortuitous hedge against some absolutely catastrophic legal risk. That wild domestic tech tension brings us perfectly into Section 2, macro and geopolitical frictions, specifically looking at competing global forces. We are witnessing a massive push and pull defining the global stage right now. On the home front, we're actually getting some inflation relief. Following a recent Supreme Court ruling, effective U.S. tariffs are cooling off, dropping from 11.8% down to 9.7%. And honestly, that should be great news for businesses and consumers alike. But internationally, that relief is being violently eclipsed by what's being called Schrodinger's Strait. Clashes between the U.S. and Iran near the Strait of Hormuz have sent crude oil spiking up 3.37% to $73.82 a barrel. So we're caught right in the middle, falling domestic costs on one hand and the sudden volatile threat of international conflict reigniting supply-side inflation on the other. Which leads us right into Section 3, navigating the AI crucible. We'll be looking at capital, volatility, and employment. Let's look at part 1 of this crucible because we have a truly fascinating dynamic playing out here. Over in the paper markets, Wall Street's investment-grade corporate bond market is actually struggling. Investors are just choking on this $75 billion onslaught of AI bond issuance from giants like Nvidia, SpaceX, and Amazon. It's signaling a desperate need to slow down the paper market. But look at where the capital is effortlessly flowing. It's pouring into hard, physical realities. For instance, we're seeing a massive $1.35 billion IPO for C-Square, a company operating 64 actual physical data centers. And at the same time, check this out, a Pennsylvania family getting a staggering $22 million real estate windfall for struggling farmland. Why? Simply because data center developers are paying massive local premiums just for the dirt itself. Let's see how this builds into part 2, the extreme structural volatility hiding behind the memory chip boom. Just look at the absolute whiplash on this chart for SK Hynix. On the way up to the peak, you have this pure U.S. exuberance. I mean, they raised a record $26.5 billion in their U.S. trading debut, with shares soaring 13%. But then, just days later, a brutal reality check. We saw a 15% single-day plunge in South Korea. This was driven by aggressive profit-taking and the amplified swings of leveraged exchange-traded funds, which basically multiply market movements. It's a really stark reminder of the volatility tax investors are paying just to play in the AI hardware space right now. But what about the human cost of all this AI? Well, the data is actually shattering a lot of mainstream narratives. This analyzes workforce records across over 21,000 U.S. businesses, and it reveals what we call the AI employment paradox. Basically, heavy AI investment isn't destroying jobs. Right now, it's actually a workforce complement. Companies heavily adopting AI saw their overall headcount grow by 10% over the next 2 years. And even more surprising, Entry-level jobs surged by 12%. So the data is proving that, at least for now, AI is augmenting human capital, heavily boosting those entry-level positions rather than just wiping them out.
All right, moving away from tech for a minute, let's head over to Hollywood for Section 4, the Great Media Disconnect, Sizzle versus Fizzle.
This is perhaps the most striking illusion we've seen the entire quarter. At the box office, things look incredibly bright. We're talking a massive boom. $5.15 billion in year-to-date revenue, making it the biggest summer Hollywood has seen since 2019. It's absorbing misfires, it's breaking IMAX presale records left and right, but the corporate reality is grim. Despite this record consumer spending, media stocks are toxic right now. We are witnessing the absolute structural value destruction of these companies because their legacy combinations, bundling distribution with production, are fundamentally failing. So consumers are spending the money, but corporate value is just evaporating into thin air.
And because these studios are failing, they're being pushed into this desperate cycle of value-destroying mergers and acquisitions. Take Warner Bros. Discovery. They recently announced an $81 billion acquisition of Paramount Skydance. Now, with a 16% upside to the closing price, the trap looks pretty tempting. But I want to walk you through this historical ledger. Think of this as the media M&A graveyard. Look at AOL and Time Warner back in 2000, widely considered the worst merger in corporate history. Disney and Fox in 2017, a debt burden that far outweighed the IP gains. AT&T and Time Warner in 2018, spun off within 4 years, losing 2/3 of its value. This is a stark cautionary tale that these media megadeals generate immense drama and huge banker fees, but rarely, if ever, generate actual shareholder value.
That brings us to Section 5, the Q2 earnings catalyst, the exuberance barometer. This week's event tracker is just incredibly stacked. On Tuesday, the big banks like JP Morgan and Wells Fargo kick things off. Wednesday brings heavyweights like BlackRock and Morgan Stanley, plus the tech bellwether ASML. Then Thursday follows up with streaming giant Netflix, chipmaker TSMC, and United Health. Now, Wall Street is demanding an insanely high bar from these companies. FactSet estimates are pointing to an S&P 500 earnings growth of over 29% for Q2. Just to give you an idea of how massive that is, that's the highest growth rate expected since Q4 of 2021. And that's just to justify current valuations. Which demands we ask this absolutely crucial question: will Main Street resilience actually justify Wall Street's sky-high expectations? We've got analysts warning of a massive sell-the-news event if things aren't absolutely perfect. The banks reporting on Tuesday are really going to be the frontline test for this. They're going to reveal if consumer resilience, specifically looking through the lens of low delinquency rates, can truly back up the lucrative spring that Wall Street just engineered. The tension between those two dials right now is immense. Let's transition over to our actionable finale, Section 6, the Market Playbook, looking at strategy and terminal events. What you're looking at here is a 4-step logic funnel from the Evercore Market Playbook, which is conservatively targeting the S&P at 7,750, holding back slightly because of the oil and macro friction we talked about earlier. To navigate these turbulent Q3 crosscurrents, they suggest hunting for stocks that meet 4 specific criteria. Step 1, they belong to an underperformed sector year to date. Step 2, they have elevated short interest, meaning market sentiment is overly cautious. Step 3, they boast exceptional fundamentals with above sector revisions for 2027. And finally, Step 4, they have an undeniable execution track record. We're talking 7 or more double beats in the last 8 quarters, meaning the company completely exceeded Wall Street's expectations on both revenue and profits. Ultimately, it's a strategy designed to capitalize on overly cautious sentiment, setting you up for major upside on earnings beats. Finally, you're going to want to keep your eyes glued to this terminal event log for the week ahead. Tuesday gives us the Consumer Price Index release, where we'll definitely be watching for that oil shock pass-through, alongside Fed Chair Kevin Warsh testifying before Congress. Wednesday brings the Producer Price Index, and Warsh continues his testimony. Then, Thursday wraps up the macro data with retail sales, and it all leaves us with a final provocative thought to carry with you. As you watch these events unfold this week, will Fed Chair Kevin Warsh signal an undoing of last year's rate cuts in the face of this sticky geopolitical inflation? That is the ultimate question for Q3, and honestly, only time will tell. Thank you so much for joining me to explore the realities behind the illusions, and I'll catch you in the next explainer.